Good morning, everyone. We're from Group 3 of Engineering Economics, and today we'll present our engineering economic analysis of Whoosh Jakarta-Surabaya planned extension for Whoosh Series 2. Next. These are our table of contents. Next. I'll begin with the introduction. So the Jakarta-Surabaya corridor is the backbone of economic activity. Therefore, there's an increase in demand for fast, efficient, and high-capacity transportation. The current situation is that existing transportation modes still face limitations in terms of capacity and travel time. The complication is that the high-speed rail project Whoosh offers a significant improvement in connectivity, but it requires a large investment. And the question is, how can we upgrade conventional railway services, which involves lower cost but comes with service limitations? We need to conduct these economic and financial feasibility analysis to compare economic feasibility of two options, evaluate fiscal and investment implications, and lastly, for an informed decision making. Next.
So here are the parameters that we use, and the key parameters are the social discount rate, financial discount rate, corporate income tax, and asset life for 20 years. Next. Here are the calculation for MPV, IRR, and PEC for the Whoosh, which MPV 93.74, IRR for 11.6%, and BC for 1.47. Next. For the alternative, we have for the MPEC for positive 32.2, and the IRR for 9.6%, and BC for 1.13. Next.
In this section, we compare the rate of return performance of the Whoosh project with an alternative investment option. The Whoosh project represents a new high-speed rail investment. It requires a high initial capital cost, but it also offers high expected economic benefits. In contrast, the alternative option involves a lower investment cost with only moderate improvement in service level. Shown in the table here, we see that the feasibility evaluation of the IRR for Whoosh and alternative is larger than the MARR with 8%. Both project meets the financial feasibility criteria with their initial rate of return higher than the 8% MAR, with Whoosh offering an IRR that is 2 percentage point higher, an NPV nearly 2.9 times greater, and a benefit cost that exceeds the alternative by 0.34. And in conclusion, from both the government, public sector, and SOE operator perspective, the Whoosh project is the preferred option, offering higher investment returns, significantly larger economic benefits, strong justification as a strategic national infrastructure project. Next.
Next, we compare the Whoosh and alternative by doing benefit and cost analysis. So after doing the analysis, both projects are economically feasible. However, across all economic indicators, Whoosh consistently demonstrates superior performance. So Whoosh provides a higher value per unit of investment, generating 1.47 rupiah in benefits. And despite a lower PV cost, Whoosh achieves a higher PV benefit, showing stronger cost efficiency, and overall, Whoosh maximizes economic returns. Therefore, it is the economically optimal choice.
Both Whoosh and the alternative are projected to operate above their break-even points in the first year, indicating early operational feasibility. However, Whoosh requires a lower passenger volume to break even and has a higher margin of safety at 44.44%, showing greater resilience to demand uncertainty. Next. The alternative option provides faster capital recovery and lower short-term liquidity risk, making it attractive for conservative investors. In contrast, Whoosh has a longer payback period but demonstrates stronger debt repayment capacity and higher operational safety, supporting long-term financial stability. Next.
Okay, next, this is the depreciation assumption, and the project involves a depreciable asset value of 200 trillion with an asset life of 20 years and a corporate tax rate of 22%. The initial investment is 200 trillion, and depreciation is an important factor because it doesn't represent a cash outflow, but it reduces taxable income and therefore creates a tax shield that improves cash flow. And we use the straight line method with a formula as a cost minus salvage value per useful life, and it turns like 6.67 trillion per year. And why we use straight line method? Because it is chosen to provide simple, transparent, and widely accepted approach for long-term infrastructure project with stable asset utilization. And then next, this is the slide compares the double declining balance or DDB method with the straight line method over the first 5 years. And we can see that DDB produces significantly higher depreciation in the early years, while the straight line method remains fixed at 6.67 trillion per year. And the tax impact is tax savings. And then the straight line method is chosen for fairness and consistency in evaluation.
Here are the after-tax economic analysis. Before the tax cash flow for the 5 years are shown here, and the tax for 22%, and after-tax cash flow is for the 5 years is shown here. By that, we have the decrease percentage here, and all this data is taken by the NPV, IRR, and the payback period and BEP that we already decided in the previous slide. For the key takeaways are the taxation significantly reduce cash flow, NPV, and IRR. And it's despite from the reduction, it's financially feasible, and the after tax IRR is still above the MRR, which is 8%, and the NPV remains positive. The payback period is long but acceptable for a long-term infrastructure project. Break-even point is not affected by taxation. For the after-tax analysis here, we recommend to Whoosh project get an implementation, and tax consideration should be included in a final decision making, and fiscal incentives and government to take the long-term investors. Next.
For the conclusion, Whoosh achieves a higher after-tax IRR, exceeding the 8% mark and outperforming the alternative in long-term returns and resilience. While the alternative suits short-term, low-risk objectives, Whoosh is the preferred option for maximizing long-term economic value. And that's all for our presentation. Thank you so much for listening.